In the second consolidation working video of the module devoted to non-controlling interest, we will be tackling a scenario which is almost identical to the one explored in the previous section. This time, however, we will apply the fair value method to compute goodwill, which will have an impact on both the computation of goodwill as well as the balance of non-controlling interest. So, example 2 reads: P acquired 80% of the share capital of S for €8,000 on the 1st of January 2017, when the statement of financial position of S was as follows. Additionally, we are told that at the date of acquisition, S's other assets included an item of property, plant and equipment whose fair value exceeded its book value by €600. This item of PPE had a remaining useful life of 4 years as at the acquisition date. What is more, at the date of acquisition, the fair value of the 20% non-controlling interest was estimated to be €2,000. Reading on the 31st of December 2017, the statements of a financial position of the two companies are as follows. We are also told that as at this date, consolidated goodwill is deemed to be impaired by €300. And our job is to prepare a consolidated statement of financial position as at the 31st of December, which therefore becomes the date of consolidation. As always, the first working concerns group structure, and we will write that P owns 80% of S. The second working is subsidiary net assets. We already discussed the composition and the mechanics of this working in the previous video, and switching to the fair value method in respect of computing goodwill has no bearing on the numbers which appear here. As a result, the 3 columns show exactly the same results as in the previous video, so if you have any doubts regarding where any of these figures come from, please refer to the previous section for a detailed explanation. The third working, goodwill, begins with the €8,000 investment by the parent entity. Next comes the NCI value at acquisition, which, seeing as we are supposed to follow the fair value approach, equals the €2,000 provided in the scenario. The two numbers are then added, giving a total of €10,000, from which we deduct the 8,600 fair value of the subsidiary's net assets as at the date of acquisition, which we take from the acquisition date column of working 2, and this yields a goodwill on acquisition balance of €1,400. The scenario tells us that at the date of consolidation, goodwill is in fact impaired by €300, meaning that its carrying amount, as at the 31st of December 2017, equals 1,100. The fourth working begins with the non-controlling interest value at acquisition, and that's the €2,000 already identified as part of working 3. To do this, we must add the NCI's share of the subsidiary's post-acquisition reserves, and that's 20% of the post-acquisition column total from working 2, so 20% of 2,350, which gives another €470. When goodwill is computed under the fair value approach, as is the case in this example, non-controlling interest will share in the impairment of goodwill, resulting in a deduction equal to 20% of 300 or €60. Accordingly, the consolidation date NCI balance equals €2,410. The fifth and final working, group retained earnings, begins with the entire retained earnings of the parent as at the date of consolidation, giving 17,000, to which we add the parent's share of the movement in the net assets of S since the acquisition, as adjusted for the additional depreciation. This is equal to 80% of the outcome of the post-acquisition column from working 2, that is €1,880. As noted already, we must also deduct the parent's share of the goodwill impairment charge, which under the fair value approach is 80%, resulting in a minus 240, which brings the group retained earnings balance to €18,640. Let us now put all of the pieces together in the consolidated statement of financial position as at the 31st of December 2017. We begin with goodwill, which was computed as €1,100 in working 3. Next we have other assets, which equal the sum of the two values coming from the books of P&S, but also include that €600 of acquisition date fair value adjustment, less the €150 of additional depreciation, which brings the total to €32,450, resulting in overall assets of €33,550. Moving on to the equity section, the share capital of the group is always the same as the share capital of the parent, so €6,000. The group retained earnings total derived in working 5 was €18,640, whereas the carrying amount of non-controlling interest also presented within the equity section is €2,410 as computed in working 4, producing an overall consolidated equity balance of €27,050. Group liabilities are the sum of the relevant P&S numbers, coming in at €6,500, which brings the balance of consolidated equity and liabilities to €33,550.